This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stocks tumble. The major averages suffer their biggest weekly losses in more than 2 years, and the Dow lands in correction territory. China strikes back. The world's second largest economy rolls out retaliatory tariffs, leaving investors on edge around the globe.
I will never sign another bill like this again. I'm not going to do it again.
President reluctantly signs into law that trillion-dollar spending bill as the drama in Washington spreads to Wall Street. Those stories and much more tonight on Nightly Business Report for this Friday, March the 23rd. And we bid you a good Friday evening, everybody. Sue's off tonight. Drama on Wall Street and in Washington again today. It capped off a rocky and ugly week for stocks. After that 700-point decline yesterday, the Dow fell sharply again today, pulling the index down more than 10% from its most recent highs, and the S&P 500 just shy of that key 10% correction level. Concerns about a trade war and the threat of a spending bill veto kept investors on edge all day today, although in the end, the president did sign the bill into law. We'll have more on that in just a moment. But first, the closing numbers. Here they are. The Dow down 424 points today to 23,533. The Nasdaq tumbled by 174, and the S&P lost 55. The crazy day capped off a crazy week. The major averages all down more than 5%, registering their biggest percentage weekly declines in more than 2 years. Bob Pisani has more now on the nervous market from the New York Stock Exchange.
Stocks were mostly sideways today until the last hour and a half of the trading day when stocks drifted lower on a large volume of orders to sell stocks at the close. The big problem is that the two most important sectors, banks and tech, are not showing any leadership. Without them, it's hard for the markets to advance. The Dow moved in a 1,400-point range this week. The market showed it cares about a lot of things. It's worried the Fed might be getting more aggressive on interest rates. It was even briefly worried that the president might not sign the spending bill, but he did. It's worried about technology a lot. That's been a key leadership group all year, but Facebook collapsed in the wake of its data mining scandal, and other social media stocks took a dive. Subsectors that powered tech higher last year, like FANG stocks, including Amazon, Netflix, and Alphabet, have sold off. Energy and utilities have led the charge this week, but they comprise a much smaller chunk of the S&P 500 that banks and tech stocks do. But the single biggest worry is trade protectionism. That's because it is potentially a threat to earnings growth, which is the main driver of the stock market. Earnings are expected to increase about 20% this year. That's a lot. So even a modest threat is enough to cause a lot of volatility. Tariffs have the potential to cut earnings growth forecasts, particularly in global industrial stocks, but it's difficult to model into these earnings forecasts because we don't know where these tariffs are going to settle out or what industries they may ultimately affect. You see, you get a lot of chaos as a result. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And China is now ready to retaliate. The world's second largest economy is threatening to raise tariffs on about $3 billion worth of U.S. imports. And concerns of an escalation in trade tensions is playing out in China's manufacturing heartland as well, where they make that Made in China label. Eunice Yoon reports for us tonight from China.
I'm coming to you from U.S. Trade Deficit Central. American companies have been relying on factories like the one I'm in right now to make them men's shirts, toys, and television sets that are eventually sold to U.S. consumers. And the word to describe the mood in this export zone is nervous. This morning, we woke up to an immediate reaction from Beijing, tariffs that are being seen as a warning shot of things to come. Now, the tariffs were a reaction not from President Trump's announcement yesterday, but to the steel and aluminum tariffs earlier in the month. And the Chinese chose their products carefully. If you look at the pattern, the Chinese are going after Trump's political base, farmers, and swing states. In California, for example, they're targeting almond country, which went for Trump. And they're looking to rattle corn growers in the Midwest who have been optimistic about selling ethanol to the Chinese. And Chinese state media today said that the next target should be soybeans. I was speaking with an American executive in the agricultural industry here, and he said if soybeans go on the table, then we really are in a trade war. And that's the big fear here. It's still not clear what tariffs will be hitting which products. Business people here believe that the Trump administration wants to target high-tech goods to counter Beijing's Made in China 2025 industrial policy. However, those products are only a small share of U.S. imports from China. So the concern is that the tariffs could hit a wider range of products. And in a low-margin business like apparel, that is going to hurt. So exporters are thinking about survival strategies. They're telling me once the tariffs are out, they will likely dump targeted products, tweak products to suit certain specs, split production to finish assembly in places like Taiwan and Hong Kong, and move production entirely out of the country to other places like Southeast Asia, but not to the United States. For Nightly Business Reports, I'm Eunice Yoon in Dongguan, China.
Now, one of the industries that China could potentially target is pork. And that's not going over very well with American farmers right now. Jane Wells has our story for us tonight.
There's never a good time for tariffs, but now is an especially bad time.
Farm income is at 12-year lows. We really need access to those markets now.
China is threatening 25% tariffs on U.S. pork. Pork, which currently enters the Chinese market duty-free, and it's a huge market, the third largest export market for U.S. hog farmers in terms of dollars, behind Japan and Mexico. Let me explain how the sausage is made. If your average American hog sells for about $150 on the market, well, $53, or a little over a third, comes from outside the U.S., and $9 is just from China. Well, that $9 adds up to over $1 billion a year. Hog futures have already been dropping as China porks up its own domestic production, and as Rabobank warns, we may be heading into a pork glut. But no one knows how much of the pork industry China may end up targeting, especially since a Chinese firm owns Smithfield Foods, a massive U.S. pork producer. Still, the news is a slap to farmers who voted for Donald Trump in hopes of making more money, not less.
We've been assured that agriculture, at the end of the day, is going to come out better than where we are today.
John Newton from the American Farm Bureau Federation says farmers have been pleased with President Trump's tax and regulatory policies. And the USDA has released a statement which says the administration stands ready to defend agricultural producers who may be harmed by foreign country retaliation. But the question remains after all this is whether net, hog farmers will end up bringing home less bacon. For Nightly Business Report, Jane Wells, Los Angeles.
And the head of the World Trade Organization is warning that a trade war could disrupt the global economy and harm the fragile recovery. He is urging restraint on all sides. He says dialogue is the best path to resolving these problems. Elsewhere, a handful of countries are breathing a sigh of relief because the European Union and others are exempt from the Trump administration's steel and aluminum tariffs, at least temporarily. Willem Marx is in Brussels at a summit of European leaders.
After a couple of weeks of uncertainty, European leaders woke up to the news Friday that the European Union would be exempt from the Trump administration's steel and aluminum tariffs, at least until May 1st. They join a select group of countries, including Argentina, Australia, Brazil, Canada, Mexico, and South Korea, who've all won the same temporary reprieve. But European leaders meeting here in Brussels have insisted that the exemptions should be permanent, amid concerns that the US will use that May 1st deadline as negotiating leverage over unrelated trade issues in the coming weeks. The EU's 28 heads of state released a coordinated statement in which they reiterated an argument made repeatedly by Europe's Trade Commissioner Cecilia Malmström to her US counterparts, Wilbur Ross, the Commerce Secretary, and Trade Representative Robert Lighthizer, this week, that national security was not a reasonable pretext for US tariffs to be leveled on European-produced metals. Europe's leaders say they're happy to cooperate with the US to deal with the problems of overcapacity, especially in terms of steel production, but the EU still reserves its right to respond to any US measures in a, quote, appropriate and proportionate manner according to WTO rules. The bottom line is that Europe says it's committed to a multilateral trading system with the WTO at its core and has expressed concerns that the current US administration is not. For Nightly Business Report, I'm Willem Marx in Brussels, Belgium.
Now to the other drama in Washington today. The Senate overnight passed that $1.3 trillion spending bill, averting a government shutdown. But first thing this morning, the president threatened to veto it. Then, as we mentioned, he reluctantly signed it later in the day. But for a while, it created a lot of uncertainty, something that Wall Street certainly doesn't like. Yolande Mui has more now on the bill and its winners and losers.
A whirlwind day in Washington after President Trump threatened to veto a massive federal spending bill, then changed his mind and signed it with just hours to go before a government shutdown. The $1.3 trillion package included big spending increases for many federal agencies, a 10% jump for the health, labor, and education departments, 11% for agriculture, 14% for the Defense Department. But Trump was upset that the bill didn't fully fund his border wall, and it didn't address the fate of young, undocumented immigrants, the Dreamers. He threatened to veto the legislation that Republicans and Democrats had so carefully negotiated. A source says that House Speaker Paul Ryan intervened, speaking with the president by phone, emphasizing all the wins in the deal, particularly the boost in military spending, including a 2.4% pay raise for service members. By this afternoon, Trump reversed course. He reluctantly signed the bill to fund the government through the end of the fiscal year.
As a matter of national security, I've signed this omnibus budget bill. There are a lot of things that I'm unhappy about in this bill. There are a lot of things that we shouldn't have had in this bill, but we were, in a sense, forced. If we want to build our military, we were forced to have. There are some things that we should have in the bill.
Trump also said Republicans are on the side of the Dreamers and that he's still open to a compromise. But House Minority Leader Nancy Pelosi fired back with this statement. Republicans refuse to join us to provide real protections, offering only a temporary patch. Now, lawmakers have already left town for Easter recess. The president will spend the next few days in Mar-a-Lago. Perhaps everyone just needs a vacation. For Nightly Business Report, I'm Milan Mui in Washington.
Let's take a look at some of today's upgrades and downgrades now, shall we? Citi cut its rating on what has been the best performing semiconductor stock so far this year. That would be Micron Technology, but it was cut to neutral from buy. The firm cited a decline in flash memory pricing. The analyst, however, did raise his price target on the stock to $60, although he does admit the new price forecast makes him nervous. Micron fell 8% with the rest of the market today to 54.21. Goldman Sachs is adding Dow component Cisco to its conviction buy list. The firm says the rally in Cisco shares so far this year is just the beginning of a bigger run for that stock. The analyst bumped his price target to $54 a share, but Cisco shares fell more than 1% to 42.42. And Barclays is raising its rating on Carnival Cruise Lines to overweight from equal weight. The firm says the company's strong bookings and upbeat outlook from yesterday's earnings report should drive earnings higher throughout the rest of this year. Price target, $77. On this down day, though, Carnival was off more than 2% to $64.41. Coming up, this week's Market Monitor has 3 picks that he thinks could do well despite rising trade tensions between China and the U.S. More executives at Wells Fargo are reportedly leaving. According to the Wall Street Journal, 4 risk management officials plan to retire. The changes follow a recent enforcement action by the Federal Reserve, which restricted the bank's growth and replaced various board members. Bank of America is going to pay $42 million to New York State to settle an investigation into electronic trading. The New York Attorney General said the bank had secret agreements with certain firms to send them orders to buy and sell stocks. Those agreements were allegedly concealed from clients over a 5-year period. And a Federal Reserve official today said that the central bank should continue raising rates gradually over the next couple of years. Atlanta Fed President Raphael Bostic cited a labor market that is at or near full employment and inflation that is approaching the Fed's 2% target. And as you know, the Fed raised rates this week and is forecasting 2 more rates this year, increases, and 3 next. Elsewhere, orders for long-lasting manufactured goods rebounded in February, reversing January's decline. Commerce Department said today that durable goods orders rose by 3.1%, thanks to strong demand for transportation equipment. Durable goods are items designed to last at least 3 years. That durable goods report also showed an increase in shipments, which could be a positive sign that business spending grew in this first quarter of the new year. 2 new reads on the housing market out this week showed a less than stellar start to the critical spring selling season, and the culprit's pretty clear. Diana Olick has our story tonight from Washington.
Homes are getting a lot more expensive, especially these homes. The price of a newly built home jumped to $326,000 in February, up 10% compared to a year ago. In the hottest markets like California and Colorado, where homebuilder TriPoint operates, prices are even higher.
The real story in housing is demand. Demand is very strong across the board, entry level all the way up to move up in luxury. That demand is really pushing pricing, both at the entry level all the way up through the luxury price point.
But new homes are needed most at the entry level, since that's where the existing home shortage is worst. Unfortunately, rising construction costs, especially new tariffs on materials, make that harder for builders.
Materials, labor, land, regulations, they've all had an impact on housing, and especially on the price of housing, because we're continuing to absorb those price increases with more price increases.
Without builders ramping up, the existing home market is only getting more competitive and less affordable. February sales bounced back after 2 months of drops, but prices also continue to surge higher.
Absolutely. That's probably my number one problem in searching for a home that I like is finding something in my price range.
Lisa Reagan has been searching for a home in the Atlanta area for about a year, but does not want to overspend.
I am concerned that I might be buying at the top of the bubble, and I have done that before, and I don't want to do that again.
Rising mortgage rates, like we're seeing now, usually cool prices a bit, but that is not the case in today's market. Demand is simply so high and supply so low that higher rates are not holding back competition. In fact, they may be fueling it as buyers try to get in faster before rates move even higher. For Nightly Business Report, I'm Diana Olick in Washington.
Boeing drops its tariff appeal, and that is where we begin tonight's Market Focus. Company is not going to appeal a recent ruling by the U.S. International Trade Commission, which allows rival Canadian jetmaker Bombardier to sell its planes to U.S. companies without steep tariffs. Now, last year, Boeing launched a complaint with the commission saying that Bombardier was subsidized by the Canadian government, which allowed it to sell planes to U.S. carriers at unfairly low prices. No appeal, though, now. Boeing shares rose a fraction today to $321 even. And Steve Wynn has cashed out entirely out of the gaming giant that he created. The casino mogul sold his entire stake in Wynn Resorts after resigning last month following sexual misconduct allegations. And separately, Macau-based Galaxy Entertainment said that it was taking a 5% stake in Wynn. Shares of Wynn Resorts were up 34 cents to finish the day at $175.88. And GlaxoSmithKline is taking itself out of the bidding process for Pfizer's consumer healthcare business. Glaxo was seen as the leading contender to buy that unit. Pfizer now says it expects to make a decision later this year on whether or not to actually sell that business. Shares of GlaxoSmithKline rose 3.5% to $37.42. Shares of Pfizer were down 3% to $34.49. And shares of Qualcomm came under pressure today after the chipmaker said that all of its board nominees have been reelected. 6 of the directors, though, faced opposition from a majority of shareholders who were concerned about how the company handled a recent takeover offer from rival Broadcom. Qualcomm shares fell more than 3% to $53.66. Our market monitor tonight has names of stocks that he says will remain valuable even with rising trade restrictions between the U.S. and China. This is his first time on our program. We welcome Jeremy Bryan. He's portfolio manager with Gradient Investments. Jeremy, good to see you. Thanks for joining us tonight.
Thanks for having me.
I'm going to jump right in with your first pick. I'm curious. It's Starbucks. You say it should do okay even if there are trade tensions between the U.S. and China. But Starbucks is making a huge investment in China. Make your case.
Yeah, so the case is just a little bit of a different story with regard to Chinese expansion, and that's brand expansion. We think that Starbucks, the brand over there, there's still a demand for Western brands in China, in the Chinese region, and we think that Starbucks is one of the predominant sources of that. We think that they're going to continue to grow in China from a units perspective, from a sales perspective, but also the U.S. side, we could see a reacceleration as well. So you get the double whammy of growth in Starbucks.
So you don't fear any kind of retaliation by the Chinese government could hurt Starbucks?
It could in the very short to interim term, but I still think over a longer period of time, I still think the brand expansion, the brand opportunity of Starbucks is too big, and it's still too in demand to be affected by that over a long period of time.
Okay. Chevron, you're making a bet on oil, and you love that dividend. Who doesn't love 4%, huh?
That's exactly right. I mean, if you look at Chevron, the interesting part of Chevron is it's back to basically about November 2016 levels. If you look at oil prices during that time, oil prices were in the low 50s then, and they're in the mid 60s now. And Chevron's at the same price. So you get that dividend yield, which, like you said, is over 4%. And then also, I think you've got some free cash flow opportunity to where they can increase that dividend and also do some share buyback going in the future.
Finally, you have Celgene. I know it has suffered, this biotech company. Is this a value play? Is that how you see it then?
Yeah, so it can be a pretty long fall from growth to value, which Celgene's kind of been through. And the funny story is we bought this today, and we think we're there. That's the thought. I mean, Celgene was at 147 about 6 months ago. It's about 85 now. And so we're still looking at a company that can do 10 to 15% EPS growth over the next few years. If they even get one of their drugs to come through and into that pipeline, this could be, a double stock in the next 2 to 3 years.
But it is a good highlight that biotech can be very, very volatile, right?
Absolutely. You have to be cognizant of that. And that's why we prefer to buy them when they're at these price levels where upside is a large potential, both from the EPS growth and the valuation opportunity.
Jeremy Bryan with Gradient Investments. Again, welcome. Thanks for joining us tonight.
Thank you very much.
And to read more about our Market Monitors picks, you can go to our website at nbr.com. And when we come back, a bright spot on Wall Street, and it came from the tech sector. The Justice Department has accused 9 Iranians of orchestrating years of cyber attacks on behalf of the Iranian government. It is one of the largest state-sponsored hacking cases ever brought by the Justice Department. DOJ says that the hackers' goal was to steal data from businesses, government agencies, and universities.
They hacked the computer systems of approximately 120 universities, approximately 320 universities in 22 countries. 144 of the university victims are American universities. The defendants stole research that cost those universities approximately $3.4 billion to procure and maintain.
And that stolen information was then used by the Iranian Revolutionary Guard, or it was sold for profit in Iran. Dropbox soared in its Wall Street debut today, investors rushing to buy into the biggest technology IPO we have seen since Snap came public last year around this time. The cloud storage company closed out its first day of trading with a gain of more than 35%. Deirdre Bosa has more on Dropbox and its strategy for growth.
As Dropbox makes its public debut, the company enters a land of land grabs. Cloud computing has been one of the hottest corners of the market over the last year, and it's not just cloud-focused companies like Salesforce and Atlassian that are playing in the field. Tech behemoths like Google, Apple, Microsoft, and Amazon are major players, and they're only getting bigger. So where does Dropbox fit in? Well, the San Francisco-based company has 500 million registered users and became a household name thanks to its popularity with consumers rather than businesses.
It's viral. It's something that's incredibly sticky, and you see that across the metrics of the company. So if they can continue to innovate and develop, which they've proved they can do in the past.
But in the file-sharing cloud business, the money is an enterprise, and Dropbox is increasingly moving into the space on its path to profitability. Dropbox CEO and co-founder Drew Houston says the company's consumer following will help it win more business customers.
So we have over 500 million registered users, and since the beginning, they've been bringing us into millions of companies. And so we have over 300,000 paying Dropbox business customers. And it starts really simply. So you start using Dropbox at home, you bring it into work, start sharing and collaborating with a team on a project, then that team becomes a department, becomes a whole company, becomes a whole industry.
Investors seem to agree. While there were concerns as to whether the public markets would value Dropbox as richly as the private market has in the past, the company's debut today suggests that investors believe there's plenty more room to grow. Now, as a public company, though, it'll have to prove that it can grab more land in a competitive landscape. For Nightly Business Report, I'm Deirdre Boza, New York.
Finally tonight, some sad news in the business world. Wayne Huizenga has died at the age of 80. He is still the only entrepreneur ever to create 3 different Fortune 500 companies during his career. They were Blockbuster Video, Waste Management, and AutoNation. He also co-founded the hotel chain Extended Stay America. And Mr. Huizenga was also a fixture in the sports world. At one time, he owned 3 professional teams. They would be baseball's Florida Marlins, the NHL's Florida Panthers, and football's Miami Dolphins. What a life. Before we go, here's another quick look at the sell-off on Wall Street. Today, the Dow dropping by another 424 points. The Nasdaq tumbled by 174, and the S&P 500 lost 55. The major averages registered the biggest weekly decline in more than 2 years this week. That is the Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for watching. Have a great weekend. We'll see you again on Monday.